The Theory of Investment Value by Burr Williams. This is a book summary. Picture this. It's the roaring 1920s. The stock market is sizzling. Ordinary people, barbers, bankers, shoeshiners, are tossing money into stocks like it's a game of dice. Prices are flying high. Fortunes are being made overnight. And then, boom, 1929. The market crashes. Wall Street turns into a war zone. Millions lose everything. Now fast forward just a few years. The dust is still settling. Confidence is shattered. And out of this chaos, a quiet voice emerges, measured, mathematical, and unshaken by panic. That voice belongs to Burr Williams. And in 1938, he publishes a book that would change the way the smartest minds in finance would think about value, forever. It's called The Theory of Investment Value. And it's not just a book, it's a blueprint. A declaration that behind every ticker symbol, behind every share of stock, there is something deeper. A stream of future income, a logic, a reason. Today we're going deep into this lost classic. We're unpacking the big ideas that would later shape Warren Buffett, modern finance, and everything you thought you knew about investing. So buckle up, because this isn't just a story about money. It's a story about clarity in a world gone mad. Chapter 1. A new kind of thinking. Burr Williams wasn't just crunching numbers, he was on a mission. At a time when markets were driven by emotion, when fortunes were made on whispers and lost on panic, Williams stood alone with a bold idea. Investment value is the present worth of future income. That's it. One simple sentence. But let's unpack the revolution hiding inside. Williams believed the market was like a noisy crowd, shouting, guessing, chasing rumors. Prices surged and sank not based on what companies were earning, but on what people felt. He saw this madness firsthand during the Great Depression, and he knew something had to change. So he asked a radical question. What if we stopped listening to the crowd and started listening to the math? According to Williams, the true value of a stock isn't what someone's willing to pay for it today, but what that stock will pay you tomorrow, and the next day, and the next. It's not about betting on price swings, it's about measuring income, dividends, coupons, principal, cold, hard, cash flows. Think of it like this. Would you pay $100 today to get $50 total back in the next 10 years? Of course not. But what if it paid you $200? Now you've got something worth holding on to. That's the essence of Williams's idea. And here's what makes it powerful. It forces you to think long-term. It strips away the noise of headlines, TikTok stock tips, and Reddit hype trains. It asks, what will this business actually earn? And how much of that will it return to me? If the answer doesn't justify the price tag, then walk away. No matter how shiny the logo or how popular the trend. In Williams's world, speculation is for gamblers. But investment, that's for thinkers, for planners, for those who build wealth, not chase it. And that is where our journey begins. Chapter 2. Speculators versus investors. Now, early in his book, Burr Williams drops a truth bomb so powerful, it still echoes on Wall Street today. Most people don't know the difference between price and value. Speculators, they chase price. They're the adrenaline junkies of the market, placing bets like they're at a racetrack, hoping someone, anyone, will pay more tomorrow for what they bought today. It's a game of timing, momentum, and a little bit of madness. But investors, real investors, they move differently. They're not looking for the next hot stock. They're looking for businesses with real earning power. Companies that generate income year after year. Because for them, it's not about what they can sell it for, it's about what it's worth to own. And here's the real kicker, straight from Williams himself. The price of a stock is not set by the wisest investor in the room, it's set by the last person willing to make a trade. He called this concept marginal opinion, and it flips the whole market on its head. The loudest, most confident trader doesn't move the needle. The price reflects the compromise between the most eager buyer and the most desperate seller. That means markets are emotional. And because of that, they're often wrong. Stocks shoot up not because businesses are making more money, but because people think they will. And they crash not because the company failed, but because fear set in. So if prices can swing wildly based on shifting opinions, how do we ever know what something is really worth? That, my friends, is where Williams turns from philosopher to mathematician. Chapter 3. Why the market gets it wrong. You've heard the phrase 1,000 times. The market is always right. Well, John Burr Williams would lean back in his chair, raise an eyebrow, and probably smirk. Because to him, that saying misses the point entirely. The market isn't some wise oracle. It's a crowd. And crowds, they're unpredictable. They cheer, they panic, they stampede. Williams believed the market was driven not by fundamentals, but by waves of emotion. Fear, greed, hope, herd behavior. That's why prices can plummet even when a company's earnings are steady, or soar when the business itself is losing money. Real worth and market price are separate and distinct things, he wrote. And he wasn't being poetic, he was being precise. He gave examples, case studies, even charts showing how bookings for steel companies forecasted prices better than market sentiment. He dismantled the idea that the market is some kind of mind reader or prophecy machine. If anything, he showed it was more like a gossip circle. Whoever talks loudest moves the price. So what does that mean for you and me? It means if you want to build real wealth, you have to ignore the crowd. You have to tune out the noise. Because real investing starts not with price, but with value. Chapter 4. The magic of present value. Alright, now we're diving into the juicy part. The magic that separates Williams from the rest. He asks one brilliant, game-changing question. What is the present worth of future income? That's it. That's the heart of value investing. Williams introduces a concept that would go on to power everything from Warren Buffett's portfolio to every MBA finance course in the world. Discounted cash flow, aka DCF. Here's how it works. Let's say you're promised $100 a year from a stock, every year for the next 10 years. That sounds great, right? But would you give someone $1,000 a year from a stock? What if inflation eats away at the value of those dollars? What if you could have invested that money elsewhere? That's where DCF comes in. You estimate every future payment the company is likely to make, dividends, bond coupons, earnings. Then you discount each of those future dollars back to what they're worth today using an interest rate that reflects both time and risk. And the total of all those discounted payments. That's your intrinsic value. If the market is charging you less than that number, buy it. If it's charging you more, walk away. It's like financial time travel. Williams gave investors a way to peek into the future, adjust for reality, and come back with a number grounded in logic, not hype. He even factored in uncertainty, showing how risk adds a premium to the discount rate, forcing you to be more conservative when things are unpredictable. It wasn't just math, it was discipline. Williams gave investors a sword and a shield, a way to fight off hype and protect themselves from panic. And that's what made this book not just theory, but survival gear. Chapter 5. Not all growth is equal. Okay, so here's where John Burr Williams separates the amateurs from the pros. He makes a critical distinction that even some analysts today still miss. Not all growth is created equal. See, some companies have already peaked. Their products are mature, their market's saturated. For them, the best-case scenario is steady, predictable cash flow. Williams calls these stocks with growth completed, and even they can be valuable if they reliably return income to shareholders. But then there are others, companies with room to grow. They're reinvesting profits, expanding operations, tapping into new markets. And if they can turn those investments into rising dividends down the line, Williams shows that even a modest annual growth rate, say 3% or 5%, compounded over time, can double or triple a stock's intrinsic value. It's not about hype, it's about the math. But here's the kicker. Williams doesn't let you get away with wishful thinking. He says, if you're going to count on growth, you need to factor in the risk. What if inflation spikes? What if interest rates rise? What if your forecasts are just wrong? That's where he introduces the concept of uncertainty premiums. He adds extra discounting to future cash flows when the future is cloudy, because he knew, even back in the 1930s, that hope is not a strategy. It's brilliant, really. He takes human bias, wraps it in mathematical discipline, and gives investors a roadmap for facing the unknown. Chapter 6: The Theory versus the Market. Now you might be thinking, this all sounds great in theory, but does it actually work? Well, Williams put his ideas to the test. In Book 2 of his masterwork, he dives into real-life case studies. We're talking General Motors, US Steel, American Telephone and Telegraph, giants of their day. He created detailed algebraic budgets to forecast their future dividends, estimate reinvestment needs, and calculate their intrinsic values. And get this, he even ran alternative scenarios to account for different inflation rates, tax changes, and economic cycles. This was in the 1930s, folks, before Excel, before Wall Street was even thinking this way. Sometimes, his valuations lined up with reality. Other times, the market went off the rails, just like it still does today. But that was never the point. The goal wasn't to predict stock prices, it was to understand value, to anchor yourself in something solid while the waves of the market crash around you. Williams gave us a compass, and when others were following rumors, he followed reason. Chapter 7: The Legacy. Now here's where it gets legendary. Warren Buffett, the Oracle of Omaha himself, has said that The Theory of Investment Value was one of the most important books he ever read. Why? Because Williams gave him a guiding principle that still shapes Berkshire Hathaway's empire to this day. Price is what you pay. Value is what you get. It's simple, elegant, powerful. And it came straight from the mind of John Burr Williams. This book laid the groundwork for modern valuation. It introduced the world to discounted cash flow. It redefined the difference between speculation and investment. And it challenged every investor, then and now, to do the hardest thing in finance: think rationally in an irrational world. And here's the wild part: it's more relevant today than ever. With meme stocks skyrocketing on Reddit threads, with AI startups commanding billion-dollar valuations before they turn a profit, with crypto swinging like a pendulum in a lightning storm, Williams' message cuts through like a laser. Focus on income, discount the future, know the value, ignore the noise. If that's not timeless wisdom, I don't know what is. So, next time you're tempted to chase the next big thing, pause. Ask yourself, what's it really worth? What cash is it going to put in my pocket? Because value, it's not a vibe. It's not a guess. It's a calculation. And John Burr Williams? He gave us the formula. Now I want to hear from you. Do you think the market is rational? Or just a well-dressed casino with better lighting and fancier suits? Drop your thoughts in the comments below. Seriously, I read everyone. And if you want more deep dives into the legends of investing, don't forget to hit that like button, subscribe, and ring the bell so you never miss a post.